Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Hello, and welcome to Live Squawk's Market Talk on Wednesday, the 17th of September. Today's episode previews the impending FOMC interest rate decision later today. To be precise, the decision will be announced at 1400 Eastern Time, 1800 GMT. To help me figure out what it all means, I'm joined today by a market savvy expert and a regular guest on Market Talk, Joseph Choi, author of popular market blog, The Curve Advisor. A warm welcome to you, Joe, and we'll come to you in a second. Before we do, though, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. Hello, Joe. How you doing?
Hey, fine, thanks. Thanks for having me on.
Always my pleasure, my man. All right, before I come to you on your thoughts, I want to read some bank research and give our listeners the median estimates ahead of today's release. So what are we looking for then? Well, it's a pretty straightforward notion here in terms of expectations. The rates currently sit at a range of 4.25% to 4.25% to 4.5%, and it's widely expected that we'll see rates cut by 25 basis points at today's meeting. Although there are outliers that we could see a 50 basis point move, and it's not beyond the realms, because I think this time last year, or around about this time last year, the FOMC went by 50 basis points. We're then looking at, I'm just give you a quick overview from bank analyst here, Mark Giannoni of Barclays, said the committee presumably judged that downside risks to employment have continued to mount given the weaker than expected pace of payroll gains, while acknowledging that inflation, albeit moderate, is still rising. So economists pointed out that data since July FOMC meeting have indicated that US hiring rate has clearly downshifted after averaging 123,000 per month between January and April. Employment growth has slowed to 27,000 per month from May to August. The latest non-farm payrolls report underscored this weakness, with just 22,000 jobs created in August, well short of the 75,000 consensus. The unemployment rate rose to 4.3%, while wage growth slowed to 3.7% year on year from 3.9%. Inflation, by contrast, is broadly tracking expectations. Headline CPI rose 2.9% year on year in August, 0.2 higher than the prior month, while core inflation held steady at 3.1%. We'll come back to the political headwinds facing the Fed Reserve at the moment. But Joe, what are your initial thoughts on what we're likely to see from today's meeting?
So this is the strangest meeting I can remember in a long time. So first, there's the drama with Lisa Cook and Stephen Mirren. Second, assuming the Fed goes 25, we may get dissents from both those who wanted a 50 and those who wanted a skip. And then third, Mirren's dots could be interesting, but maybe not meaningful. And I'll get into that a little bit later. And then four, Powell was surprisingly dovish at Jackson Hole, and that could be interesting just to see if his tone has changed since then. So I guess so I don't really want to get into the whole Lisa Cook and Stephen Mirren issue. Well,
you have in your blog, you've done. I'm a keen reader of your blogs, and you're a little bit scathing in some respects. I don't think it's a surprise to say that about the way things have been handled, really on this front. But more importantly, you sort of mentioned how that might factor into more about the market perceptions as opposed to the Fed. The Fed will do what the Fed does. You know, there are a number of individual members that act collectively, and therefore, you know, one person joining the board at this point isn't going to be a game changer, but it's going to be interesting. And the dynamics that we've already seen play out, I think, are quite interesting as well. With his inauguration, effectively him being sworn in by a judge rather than I think by a pal, which is that the normal? I think that's the norm. The dynamics are already starting to play out a little bit, really, in what we've seen in this 2-day meeting. So I know you don't want to go into it too much. Do you want to just brush over your general thoughts? Then we'll get that out of the way, and then we can look at the dynamics of what Mirren brings to the table.
Oh, sure. So I guess the markets just assume that if we get a dovish Fed chair, that the policy is going to be dovish. And I guess my contention is that one vote doesn't matter, especially if the markets think or I'm sorry, the other FOMC participants think that one voice is tainted. And so I think there will be pushback from the other members, especially if someone who they perceive as a shill is selected to be the Fed chair. And so I think the only way that the Fed could lose its independence is if somehow Trump could get control of half the votes. And I just don't see how he can get that done. So I think his attempt at it was to try to get Lisa Cook fired. And maybe if he could get a few other people fired, he could get the 6 votes. But I basically think of the Fed's reaction function as a giant S curve, where even if Trump did get Mirren, the new Fed chair, Waller and Bowman, that's just not going to be enough to get the 6 votes that he needs. And so I guess there was a little bit of a scare when we were thinking that Trump could get a majority of the Fed governors, and then maybe he could kick out some of the bank presidents. But I mean, there's so many bank presidents, and they all act as backups. So even if he were to get rid of some of the voters, he's just not going to be able to get enough people off, from the voting ranks.
Sure.
And so I just don't even see and then the other thing is, it's not even clear to me that if Waller or Bowman didn't get the Fed chair job, if they're going to keep going along with playing nice on the on the dovish rate story,
because being very cynical. I love it. I love it. I think it's brilliant.
Yeah, I mean, because the thing is once you don't get the job, you're not interviewing anymore. I mean, because the thing is, Bowman was a hawk not too long ago, and so ever since the position opened up, she suddenly became, the second leading dove. So she can change quickly. I'm not saying she will, but I'm just saying that, the markets are just making up all these scenarios, and I'm not sure that realistically the scenarios can come to pass.
Well, listen, the market's a great gossip, as we, over the years. It doesn't take much to get people talking and just really supposing this and supposing that. So I don't think that's anything new. And listen, we've had Fed voters pivot before. You look at Bullard was a famous one. Bullard was always, in my book, the unreliable boyfriend, if you like, of the FOMC, because you'd be so convinced one way and then you completely flip and turn. Maybe that's the right way to be, and to be flexible as the situation calls for it. So, all right, so we've got that bit out of the way, the politics of it all. But ultimately, they are cutting today because there's a requirement to cut. This isn't so much of an insurance cut anymore. This is, some may still call it an insurance cut, but it's seen as more of a necessity now to try and kickstart the labour market, which they have, Powell himself has referenced as more important and more out of whack, more out of balance than the inflationary picture right now. Do you go along with that? I mean, we had inflation data last week. It's still sticky. It's still above the target. They seem less worried about that than they do about the fall in the labour market, and maybe rightly so. We've seen I don't think the trend is trended lower, but I think since we've had that annual revision, it's really played on everyone's mind far more than it had done previously.
Yeah, I mean, I think the labor market data has been concerning. So the payroll revisions have been noticeably weaker, and that tends to happen in recessions. So my central case is not to call for a recession, but the markets seem very sanguine about the prospects of further fall in the economy. So even though, in my mind, the recession risks have increased, uh, vol's been grinding lower. So the markets expect the Fed to get towards neutral and then just sit there because the economy will be fine. And that's not completely clear to me. So not only have we had the lower payroll revisions, the QCEW data
Mm.
last week showed that payrolls in the year ended in March were 911,000 overstated. And I'm assuming that there's going to be a high probability the weak payrolls that we got the last 4 months will get, revised down further as well
Right.
in the next in future QCEW, and so that means that we may be sitting on 4 months of negative payrolls, and so in a way, I think the market's sort of been ignoring that, saying things like the break-even rate of employment to keep the unemployment rate unchanged has fallen, and so you should expect lower payrolls, but I just think anytime you get a bunch of negative payrolls, that should be alarming to everybody.
Okay, but I
Uh,
want to push back a little bit on that because yes, the labour market is important. It's part of it's one of the two. It's a dual mandate. It's one pillar of the dual mandate that the Fed has. But you saw retail sales data that was buoyant earlier this week. It's led people to calculate that we could see roughly 2% growth rate out of the US. Oh, that's suboptimum. That's not recessionary territory. That's not. We're not. It's not scraping the floor on that front. And inflation potentially has peaked. We haven't really seen the follow through from the tariff situation in prices to any alarming degree. So, all right, the labour market itself, and there are inputs to that. With what's going on with the immigration and illegal immigration push, and the way they're working with that, and everything else that happened earlier in Doge, which obviously I think was at government level rather than federal level, if I've got that the right way around. So, are there just too many alarm bells not ringing, shall I say, that people should be aware of? As I said, I know that what you say about the labour market and everything else, but the Fed can only do so much, and then it's down to what the government wants to do. And how far down the line do you want to look with all this?
oh well, so the retail sales I think can be a little noisy, and it's not clear to what extent some of it has been stockpiling.
Mm,
But uh, I guess I choose to just primarily focus on the two sides of the Fed's mandate.
sure.
And so to me, the employment looks weak. And then while we haven't made any progress on the inflation mandate, I actually think a good way to look at the balance of risks is to look at the second order derivative,
Mhm.
meaning if you look at how inflation has changed the last 6 months, it's been elevated, but it's been fairly stable. Whereas you can't say the same about the employment data. And, in some ways, it's not clear to me if, because retail sales tends to be very noisy, it's not clear to me if that's necessarily a sign of strength in the economy, because the one thing that we have seen is that the post-COVID recovery has been K-shaped, and so the wealthier half or quarter of the U.S. population has just done really well because the stock market keeps making new all-time highs, so they have money to spend. But the majority of Americans, I don't think, are doing particularly well. And so, again, I'm not saying that recession is my central case. I'm just saying, this is how the balance of risks are starting to look to me, because I was in the, you know, slight stagflation camp for most of the year. And I didn't really have any clarity up until, maybe about a month ago.
Right.
But the data has gotten noticeably worse. And so, so I guess that's why I've just done a small pivot in terms of how I see the risks on the
Sure.
economy.
No, understandable. If we go back to, I'm going to go back to some of the bank notes here as well, because I've got a note from Morgan Stanley, and if we turn now to the projections and the staff projections, they think, this is Morgan Stanley, they think the median dot plot will still show 2 cuts this year, though they expect data in real time to move the Fed to cut consecutively through to January. And for 2026, this is Morgan Stanley, now expects the median dot plot to show 2 rate cuts versus 1 previously, which would then go in along with what you're saying in terms of what you're seeing and maybe what economists are focusing on, which is the labor aspect of what we're seeing and potentially the broader slowdown, although we've still got a fairly resilient consumer and household stateside at the moment. So the dot plots are going to be one, I think, that everyone will be looking toward for some sort of guidance as to the further amongst members for further cuts. Again, that mirroring factor plays into that, or whether he's joined by, again, as we said, other members looking for a deeper cut. Again, the prospects for a half-point cut aren't really more than, I think, 10 or 15% at the moment. But do you see any messaging around that within the statement that could lead people to go, oh, hang on a minute, this is they're getting more dovish, or is that dovishness, in your opinion, baked into the current pricing?
So actually, I think there are a number of different ways the Fed can signal. So I guess what I'm going to be looking for is Powell's tone, because his Jackson Hole pivot was very unexpected, because he went from sounding hawkish, his prior appearance, and then he suddenly went dovish. And I'm assuming that the Fed staff brought him some concerning data, which is why he made the pivot, and not some other weird political reason, which I don't want to get into. But if you look at the data since Jackson Hole, I don't think there's been any piece of data to make him think that inflation has gotten worse. However, the employment data, I think, has kind of fallen off a cliff, since Jackson Hole. So, especially with the downward revisions on both payrolls, the week payroll, the QCEW. And so I think if Powell was slightly concerned at Jackson Hole, he has to be very concerned now. So
Right.
so I think the markets are going to focus on that. The one thing that I hear is regarding the dissents. Like, there are some people expecting, uh, you know, maybe one or two hawkish dissents. And it's not clear to me that is going to happen, but who knows? Because I think people can be very polarized. But just getting back to my looking at second order derivatives, I do think the rate of change of employment has gotten much worse, and the rate of change of inflation, while high, is still about the same. So I think that dissents can be somewhat informative. And then with respect to the dots, I'm actually looking at a couple of things. So one is Bloomberg has the dots showing only 4 eases
Okay.
through the end of next year, and but the markets are pricing in 6. So clearly, there's like a little bit of a disconnect between traders and economists.
Right.
Because economists are the ones that do these dot estimates.
Mm.
The Fed has economists that compile all the data, and then whereas the traders are the ones that actually put money on the line to uh, to
Yeah.
wager
So put
on
the
what
money where
they
their
think
mouth
will happen.
is.
Yeah, and so it'll be interesting to me if the Fed voters
Mm.
will adjust the dots to more closely match what the markets are expecting, like that they're seeing the same downside risks to the economy.
Mm.
So that's one thing I'm going to be looking at. And then the second thing I'm going to be looking at in terms of the dots is that Miran probably submitted his dots because he's there symbolically for 4 months or whatever.
Sure.
And so I would think he would want to show where he thinks rates should be, because otherwise,
What's the point?
yeah. Otherwise, it's like, what's the point of him being there? I think he
Mm.
wants to, be like the Trump mouthpiece in a way, and just say, hey, I think shorter term rates should be down here. And so, while I do think the markets should ignore what he has to say, I think because his one vote doesn't matter.
Yeah, they shouldn't
Uh,
focus on Powell says as much, don't focus on the one, focus on the whole.
right, but I am curious if his dot is going to be at 1% or if it's going to be at 3%,
Right.
or 2.5% or whatever. Because I'm actually wondering what Trump, and or Mirren are actually thinking in terms of where they think rates should be. Because uh, it's Trump's nature to talk a big game,
Mm.
about the Fed needing to cut 300 basis points or whatever. But then it's like another thing to actually have your minion go to the meeting, and then I mean, he is allegedly a respected economist, so and then have him actually put his name next to a dot. So
Go on.
the thing is, like, for example, Waller and Bowman, I mean, I still expect them to submit reasonable looking dots. So it's not that I expect 3 sets of dots around 1 or 2%.
Mm.
So I do think uh, i- once you have to put your name next to a dot, that a little bit more clarity comes in terms of what the opponent is thinking. And so so I just find things like that interesting.
Okay, awesome. I'm going to wrap this up now because you know today's decision is pretty much, as I said, it's a slam dunk that we're going to get a cut. The 25 basis points is pretty much what is fully priced in and fully expected. Anything else would be a surprise, really. I've got a note here. This one's from, again, it's Morgan Stanley on this note, and just to give you what they think. And they say the statement probably repeats that growth moderated in the first half of the year. The Fed's labour market assessment probably softens. In July, the Fed characterised labour market conditions as solid and unemployment rate as low. In September, the statement, we expect the FOMC instead writes that the job growth has slowed while still acknowledging low unemployment. On inflation, the FOMC probably again says that inflation remains somewhat elevated and elaborates in some way on the temporary upward pressure it puts on tariffs. They see a change in the opening statement that previously read, although swings in net exports continue to affect the data, and they think that will be replaced by recent indicators suggest that growth of economic activity moderated in the first half of the year. Job growth has slowed, although the unemployment rate remains low. And they take out labour market conditions remain solid. And there's a couple of other changes, but they're not too much in the way of changes. So again, it's going to be interesting there. As I said, the press conference is going to be revealing in terms of, I'm sure he's going to get pressured on Mirren and his thoughts on that. But again, I don't expect Powell to get anyway political in that sense and to say anything outside of his monetary policy remit. So decision, as we wrap this up then, tonight at 1800 GMT, 1400 Eastern Time. The press conference is half hour after that at 2:30 local time, which is where I think we'll get the most revealing comments and revealing market moves, I guess, for this. Do you think the market's already looking, I know we talked about the reaction function, do you think the market's already looking past today and really just want some sort of idea of how to treat the next 3 months for the short end, really? And then we go to 2026.
Yeah, I mean, I don't think Powell is going to be particularly committal. I think a lot of people are looking for this year's dot to tell them if they think the Fed's going to move once or twice. But I think on top of that, you have to overlay the fact that we're going to get more data, and their opinions may change. I guess what I'm looking at is that the key for me is just what Powell's tone is, because assuming he remains consistent with Jackson Hole, I'm just not sure that he can sound that hawkish when the employment data has gotten worse and the inflation data has been somewhat muted. But I'm definitely going to look at any kind of tone change to see, what I think the Fed's reaction function is going to be.
One last question before you go, is I'm doing a Columbo here. Do you think they are behind the curve? Do you think Powell has been too obstinate because of the pressure he's been under from the president? Should they have moved sooner than this to try and cut off what we're seeing now from the labour market?
Hindsight's always 2020. Because at the time I didn't really think July was a mistake when they held, mostly because people had been expecting inflation to surge. And even now you still get the narrative that inflation's going to finally surge because companies may pass along more of the cost this time. So that's just been a constant narrative. I think the main thing that has changed is just the employment data. And, the Fed always will react to how the data comes out. So if they actually had, the last two payrolls in July, then they absolutely would have cut. But it's very easy to point the finger when you're looking back. And, the people that are saying the Fed's behind the curve, they just have a faster trigger finger. But that doesn't necessarily mean that that's the right policy. It's like different people have different thresholds for when they feel like they need to make a move. And, some people are going to have a faster trigger than others, and some people are going to have a slower trigger than others. And so, I don't know that that's necessarily right or wrong. And, I didn't hear like a big clamoring of the Fed needs to ease back in July. So I don't know that, that I can necessarily fault the Fed for being cautious about inflation, especially since we saw what inflation did post-COVID to the economy.
So a bit of PTSD has really held them back in terms of maybe getting a clearer picture of what was needed at the time. But like you say, we didn't know the tariff effect. Although, I mean, some have been saying for a while now that we'd have to wait until September, October. I think Sam Cutler, one of our other guests from 333 Capital, said it, and you may have mentioned it as well, that, we only really got the meaningful tariffs midsummer, not in the April period. And so therefore, and you said there were, like you said, the importers were holding back on passing on those costs. So we may yet still see that inflation push prices higher as we come into the winter months. You don't know. Anyway, listen, Joseph, thank you very much for your input today. It's been much appreciated.
Oh, well, thanks for having me on.
No, again, a pleasure as always, and it's good to have you back. We've been missing for the last couple of episodes that we've been on. And just to really recap then, and where you can find Joseph Choi, the Curve Advisor. If you go to Substack, you'll find him there. We'll put up the links as well, so you can look for him. And just to really recap today's expectations there, we're looking for rates to pick up 25 basis points. We're looking really for maybe a slight change in the language. There'll be updated projections, economic projections that are likely to maybe tip growth slightly higher, and maybe inflation a little bit there as well. So we'll look for the. I think inflation is expected to maybe tick a little bit lower over the short to medium term, but we'll have a look for that as well. And it's really the language, as we say, and with that dynamic of having a Trump shill, shall we call it, in the form of Mirren, sitting on the board today and having his input scrutinized by the market. So a lot to pick apart at today's meeting. And you can listen to it all at livesquawk.com. Take a free trial out or log in if you remember, and listen into the rate decision, which comes at 1800 GMT, 1400 Eastern Time.
Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.